Did you think investing was going to be easy? Personally, I did too, and to be fair, I've made a killing in both the stock market and the crypto market, and I'll continue to do so. But my God, I'll be honest with you, it was challenging in the beginning. I've personally made mistakes, I've had painful lessons along the way, and missed opportunities. So I'm not going to sit here and pretend that hasn't happened to me. It has, and I've learned from them. And to be honest, I wish I knew then what I know now. But frankly, over the years, I've not only built my own success alongside my brother, but I've studied the most strategic and successful and sharpest investors alive: hedge fund giants, market legends, and strategic thinkers who play at an entirely different level that most of us will never reach. And here's the cold truth: investing isn't just complicated, it's ruthless. It's unforgiving and filled with traps that are designed to separate us retail traders from our money. And it takes years to truly master. And I'm not here to tell you that you can easily get rich overnight and sell you fantasies about easy riches. I'm here to tell you just how difficult it really is. But more importantly, give you the lessons that can turn the odds in your favor. Because the reality is, retail investors like you and I are playing a game where the rules are almost 100% rigged against us. So if you want to stop gambling, start winning, and put yourself ahead of 99% of investors, pay close attention, because I'll share 20 brutal truths about investing, lessons that will make your journey 10 times easier, things you will not learn in school. Because investing isn't just an art, it's a science. Lesson number 1, avoid day trading. The odds are against you. There's a big difference between day trading and swing trading, and there's a reason why the most successful hedge funds don't gamble on short-term price swings and make most of their money on day trading. As a matter of fact, they generate the majority of their profits through very well-researched long-term positions rather than day trading, and they actually put on 1 to 3 year positions backed by deep research and strong fundamentals. Meanwhile, you have these YouTubers and influencers trying to sell you courses and fantasies of getting rich quick and quitting your job through day trading. But the truth is, most day traders actually burn out and lose money on a lot of fees, bad trades, emotional decisions. So instead of chasing quick wins, focus on long-term investing strategies where time is on your side. The market doesn't care about your feelings. It doesn't matter how much you believe in a stock or a crypto asset. The truth is, the market moves based on liquidity, institutional money, and macroeconomic forces that you and I have no control over, not your emotions. So detach your feelings and focus on data-driven decisions. Okay, this is a big one. Being early is the ultimate cheat code. The biggest profits come from positioning yourself before the masses catch on. Okay, the wealthiest investors don't follow trends. They spot them before it happens and they get in early. So the key is do what they do. Institutions and insiders actually accumulate quietly when no one is paying attention, when there's no price action, and then they offload to the public. And unfortunately, that's when retail buys the hype. So by the time something is already mainstream, the real money has already been made. Buy quality cheap. What does that mean? Well, it's not always about what you buy, but when you buy. So invest in great businesses or cryptos at bargain prices, not mediocre ones at fair prices. Because the truth is, being a contrarian means that you recognize mispricing when you see it. And when investors are overly bearish, you should be overly bullish. So seek out top-notch, high-quality assets that have the fundamentals, the utility, and lasting advantages. And find them and get in them when they're undervalued, not overvalued. Because even great assets can become overvalued. And your job as a smart investor is to get in early when these quality assets are undervalued and under the radar, because paying less for excellence beats overpaying for average any day. and your returns will compound so much faster with quality at a discount. So buy quality for cheap. Avoid following the legacy media for investment advice. Okay, I can tell you 100% the media thrives on sensationalism, pushing narratives that drive short-term hype rather than long-term value. Okay, they are master of narratives and they use it to their advantage to exploit us and exploit fear. Okay, we all know how much media and self-proclaimed experts can sway our thinking. It happens to most of retail investors. So if you rely on the media, the mainstream media, for investment tips, you're likely reacting to trends after they've already played out, and you'll make very poor choices. The smart investors, the whales, the institutions, they make decisions based on data, analysis, and strategy, not headlines. So stay focused on your goals and avoid distractions that are led by mainstream media and so-called experts. Thank you, Jim Cramer. Think long-term, okay? Tune out the short-term noise. Wealth compounds over years, not days. So you need to change your mindset. Ignore the daily ups and downs, the price action, the volatility, because that's irrelevant. Focus on where an asset will be in years from now, not days from now. Holding strong investments for the long haul actually lets time multiply your money. So patience is actually your edge when it comes to investing. Risk management is the difference between creating wealth and being completely wiped out. No matter how good your research is, things can go wrong, and you could bet they will at some point. So don't invest more than you can afford to lose. Never invest money that you need immediately, and use stop losses if you feel it works for you. And most importantly, avoid using leverage. Okay, you don't need that in a bull market. And focus on proper risk management to prevent a single bad trade from destroying your entire portfolio. The best investors don't focus on winning every single trade, okay? They primarily focus on not losing everything. So risk management isn't about avoiding risk altogether, because the truth is risk-free investments will usually bring you risk-free and mediocre returns. You want good returns, so focus on taking risks in a clever and calculated way. Be a contrarian, okay? When everybody agrees, you should be skeptical. The most successful investors are contrarians because they see what others miss. When the crowd panics, they buy. When greed takes over, they sell. The point is, they go the opposite direction, and not because they just feel they need to, but because oftentimes it's the crowd that is getting things wrong and seeing things in the wrong way. So they don't follow the herd, they exploit it. Therefore, markets reward those who think independently, not those who chase trends. So always question the crowd, question everything, and when they're all in or all out, they're often wrong. And history has proven that. So if you want to succeed and make above average returns, you should think differently. Be a contrarian when it makes sense, and have the discipline to go against the herd mentality. Respect market cycles. Understand them, learn them, at least on a basic level. Markets move in cycles. Just like currencies go through cycles, empires and economies, markets move in cycles. They have booms that turn to busts, and the busts set the stage for the next boom. You see, markets are cyclical due to human behavior. They go up and down in cycles. And they do this for economic conditions, macro factors like interest rates, government policies, money printing, and the list goes on. But optimism drives up prices, and that creates a boom, followed by a bust when fear causes selling. So understanding these cycles, at least on a basic level, allows you to buy low during downturns and sell high during rallies. You don't have to predict every single move within the cycle, but understanding where we are in the cycle actually helps you know when you should be buying, holding, or selling. So if you have any questions about any of these topics we typically cover, whether it's investing, market cycles, digital assets, precious metals, wealth preservation, risk management, or any of these lessons I'm covering in this video, you can actually speak with me and my brother one-on-one. You could book a video call with us and we'll be happy to talk with you. I put the link in the description and you could reach out to us there. You have to control your emotions, okay? Put your emotions aside. Emotions make us do stupid things, okay? Things that actually destroy us in financial markets. Greed and fear really do cloud our judgment. So the key is to stay rational when others panic and don't let your emotions make your decisions for you. Don't let excitement make you overbuy or fear make you undersell. Emotions distort reality, and this is the worst thing that can happen when we're investing in markets. This is a key element to success in markets, and I know it's easier said than done, but this is why it's so important to have strong conviction and belief in your investment. Because if you do, then it's actually very easy to avoid getting emotional. After all, you know what you hold and you know what you own. So you can feel confident without being emotional, even during huge price swings or even crashes. The truth is, if they told me a meteor was going to come hit the earth, I wouldn't sell any of my crypto or stocks because that would be emotional. If they told me Cardano was the next world reserve currency, I wouldn't go buy it because that would be emotional. So put your emotions aside. It's the best thing you can do as an investor. Time in the market always beats timing the market, but only if you're in the right assets, because trying to time every top and bottom perfectly is nearly impossible, but holding high quality assets long enough actually allows you to ride out volatility and benefit from long-term growth. Just make sure you know what you're holding and you're not holding onto weak assets that never recover. If you realize that you got into an asset that is the wrong asset and it's probably never going to recover, it could be crappy fundamentals, you bought at the wrong time, whatever it is. If you realize that it's a big mistake you made, cut your losses, okay? Do not wait for it to go down to zero and you lose everything. If you realize it was a mistake and you have conviction in that, cut your losses sooner than later. Do your homework. Deep research beats hot tips any day. Know what you own. Do your research and do the due diligence and dig into every investment before committing, because thorough research gives you the confidence to act and gives you the conviction in your investment regardless of what happens in the short term. It could crash, it could have all kinds of volatility in between, but at least if you know what you have because you did good research, you could sleep well at night. And knowledge is your best weapon when it comes to investing in markets. Volatility is your best friend, and crashes are a blessing in disguise, whether you know it or not. Most people fear volatility, they fear corrections and crashes, but the truth is that's where the biggest opportunities lie. And most retail investors don't understand this. Rather than reacting emotionally, learn to buy when fear is high. This is when the institutional money and smart money accumulate, okay? And I know our gut reaction, it's just natural to sell and cut your losses, but this is the worst mistake we can make because wealth is built in the downturns, not in the uptrends. So when you have opportunities like that, it's like a Black Friday sale, and we need to take advantage of it. Stay liquid and have cash, because cash is king when opportunities or crises hit. Okay, imagine a market crash where everyone is forced to sell in desperation, like we saw in 2020, 2008. Those with cash actually stepped in and bought assets for pennies on the dollar, while everybody else was forced to sell. The truth is, even Buffett did this in 2008. Buffett famously stepped in the markets in 2008, buying assets for pennies on the dollar, and many others did this in 2020, including myself. So cash isn't just safety, it's ammunition for when real opportunities arise. And if you don't have money ready to deploy on the sidelines, when prices become very cheap, then you'll miss out on a buying opportunity. And why would you want that to happen? So if you can, have cash ready in case a crash or a nice correction comes in. Avoid FOMO, fear of missing out. chasing hype leads to disaster every single time. We see it happen all the time with retail traders. FOMO is one of the most destructive emotions in investing. We've all seen those crypto coins, and digital assets skyrocket. And when you don't jump in, it feels like you're missing out. Well, that's what FOMO is. The thing is, that boat is often sinking fast already if you're trying to chase a green candle or jump in when it's already up there. The truth is, you're chasing trends. You're not making smart investments. You're just reacting to fear of missing out. So when prices skyrocket, it's tempting to jump in, fearing you'll miss out. I understand. We've been there. I've been there before. But by the time the crowd already piles in, the smart money is already selling at that point. That's why they use retail as exit liquidity. Look at Bitcoin in late 2017 or meme stocks in 2021. Retail investors rushed in at the top, only to watch their entire portfolio crumble. So if you're buying just because everyone else is, or everyone is talking about it, you're already late to the party. Most retail investors lose because they're chasing hype. The smart investors accumulated before the masses came in, and they use the masses to buy at the top as exit liquidity. So if you're buying in late, you're somebody's exit liquidity. So don't FOMO. You need to have a plan. If you don't have a plan, I can guarantee you're the exit liquidity of somebody selling at some point. Without a plan, investing is like driving a vehicle without a map. Okay, you might end up somewhere great, but most likely you'll be lost. And that's the same thing in investing. The pros don't just jump into trends blindly, okay? They have a very clear, solid plan. They have an entry strategy. They have an exit plan, and they have clear risk management. And this is what we need to have if we want to make above average returns. If you're impulsively buying and selling with no plan, you're funding someone else's profits, and the chances of you losing are extremely high. So have a plan and stick to it. Bet big on conviction. What does that mean? In simple terms, when you're certain on your research and your investment, go hard, because mediocre bets dilute your returns, and it's not worth it. When your research tells you that there's an opportunity and you truly believe in it, put real money behind it. Don't spread yourself too thin on lukewarm ideas, because ultimately that weakens your gains. When conviction is high, size up that money behind it, because hesitation is only for amateurs, and you're not going to succeed much if that's the approach you take. The biggest gains come from concentrated, well-researched opportunities. So spreading capital across too many mediocre plays will only dilute your returns. Wall Street's elites don't do that and make a killing by playing it safe. They go all in on a few very selective investments that they felt are the right choices. Diversify your investments, okay? Diversification isn't about owning every single thing. It's about owning the right things. True risk management isn't just spreading your bets, okay? It's strategically positioning capital across high conviction plays. And this is what we do in crypto and with stocks. So size up where the edge is undeniable. Get into multiple investments that have a very strong economic moat, but maintain that balance, because even the smartest bets can take an unexpected turn, and it happens. But the key is to diversify into the high conviction bets that you have, okay? The ones with strong fundamentals, with strong utility, because let's be honest, there's more than one. And to think there's only one is extremely naive. So diversify strategically into the best ones out there. Master second level thinking. What does that mean? Well, the most successful investors don't just accept what's presented to them. They dig deeper and they look beyond the surface. We need to do the same thing. Often, when something is in the spotlight, it's a distraction from opportunities that are overlooked, and it's a distraction to divert your attention from something more valuable. So look here, not there, as my brother always says. Now, instead of following the crowd, we should be asking, why is something priced the way it is, and what others might be missing? question why the mainstream media is focusing on a particular asset. Most times, the real value actually lies in something that the attention isn't on. Investing isn't a game of luck, it's actually a game of strategy, patience, and understanding. The lessons I've shared today are the foundations of success, not just in the financial markets, but in my opinion, in life. So if you want to outperform the masses and mediocre gains, you have to think differently. You have to be patient and you have to take risks. Just make sure they are clever and calculated, because investing isn't just an art, it's a science. Until next time.